Hey everyone, welcome back to another episode. So this is another deal analysis, and today we are talking about a Nomad property that a client purchased in Westminster. And actually this is another Nomad in Westminster because I believe the previous deal we released was another single family Nomad property in Westminster. So similar type of property, similar location, but actually it's a completely different deal. So my co-host today is Preston Newberry. Preston, how's it going?
It's going great, Chris. Thanks for having me on. I'm looking forward to chatting about this deal. This was a fun one.
Yeah, and so this is when we closed on Q1 2020. Actually closed on right as the COVID pandemic started shutting things down, right? It was like mid or late March we closed on
Yeah,
this?
it was, I think, mid-March on this one, and right as everything kind of started to get crazy, so we were rushing to get this one to the closing table as we didn't really know what was going to happen with the rest of the world.
Yeah, and so this is actually a really good deal to talk about because we used a VA, or our client used a VA loan with very little money out of pocket, but also we had a tight deadline that we had to go up against. So we had been working with this client for a while, and then when he's ready to buy, he thought he had more time, but then like right around March 1st, we started looking, and he needed to be out by like before the end of March.
Before the end of March, yeah.
With his current lease, because that had changed with the owner who was selling the property now, so kind of like really just changed his deadlines.
It really accelerated the whole process for us. Yeah, we were kind of under the gun on this one.
And so fortunately, normally this was caused us more stress than normal because this client, great to work with. He'd already done a lot of his prep work. He understood what he wanted. He'd done his deal analysis. He was just waiting for a couple things to line up so he could go out there and buy this first property. Then we had the curveball with his landlord selling his place. And normally it's not a huge deal because what happens is a lot of the loans we do are 5% down conventional loans, and we just rush the appraisal. Spend an extra
we can
$100.
Consolidate the timeline on that, and we can usually get something closed in as little as like 8 to 10 days. Something like that. Typically about 2 to 3 weeks. So we're looking at maybe 21 days on the closing time frame. But with the VA stuff, we're a little bit bootstrapped as far as that goes with just timelines on the VA side of things and how they process stuff. So we had to really pull some strings and make this one happen.
Yeah, and because, so everyone understands, so this is why it's just really important to, always have, why we work with, like, great lenders. In this case, this was Joe Massey did this loan, and he obviously knows investing in house hacking. But since this is a VA loan, they have to use a VA appraiser, where all the other types of loans, they can use, a third-party independent company, and that's where you can pay it to rush it and get someone out there. But with VA, you're just thrown in the queue with everyone else. They don't care about your deadlines or whatever.
Yep, you're just another number in line there, and so you're kind of limited by how quick they can get somebody out there.
And so another reason we were concerned about the timeline on here, since we didn't have that control over it, this is right as interest rates were dropping, so refinances started spiking up. So even if people are doing a refinance on their VA loan and they're keeping it as a VA loan,
they still had appraisals in there, right? So those all got thrown right in the same queue with all the new purchases. So
luckily, we got our client, under contract, very quickly because we had been already kind of searching for properties. He knew what he wanted as far as like the criteria. But once we're under contract, we acted very quickly and get that over to Joe. Joe acted very quickly getting the VA queue. And just fortunately, it all worked out.
Yeah, everything played out, and big kudos to Joe and his team over at Castle & Cook. We work with those guys quite a bit, and they've got a really, really good team and good processes over there, and I think that was a big part of the success of getting this deal done as quick as we did.
And so a little bit of background about this client. Obviously, he's a veteran, no longer active military, but he's a veteran, and he's able to use a VA loan. And the reason VA loans are so attractive is you can put 0% down as a down payment. Now, of course, you have to bring some cash to close, but you can truly bring 0% down for closing cost, for down payment. And really, his main goal was just to buy a future rental property.
He just wanted a good base hit. I know we talk about that a lot, but he didn't have really any major expectations about a property. He just wanted something that was going to be a good rental, something with a yard for his dog, and something that would be comfortable for him to live in.
And no surprise here, but where we sourced this deal, it was the MLS. So far, all the house hacks and nomads we've done have come from the MLS, just because that's the best place to buy those properties. So this one came off the MLS. Now, why do we like the property? So this is a single-family house up in Westminster near 108 and Wadsworth. 3-bedroom, 2-bathroom, and it was listed at $349. Now, Press, I know there was a couple other people looking at this property too, or a couple other offers, right? Like, what were the details on that?
Yeah, so this property had actually previously been under contract and fell out. I think the buyers had some financing issues or something like that. And so, the market was still pretty hot at this time, and they definitely had some other people circling around and some offers on the table. But, just kind of building their relationships with agents and making things happen and letting them know that, hey, we're going to get this deal done was a big part of this. And the client that was selling the property was moving out of state, so they just wanted to make sure somebody was going to be able to perform and close on time so that, everything would work out for their timelines as well.
And while I like the property, like I said, good location, good price point, good rent to price point ratio as well. But from that previous under contract and inspection, they had repaired and certified the roof.
Correct.
And it was an updated kitchen and newer appliances, and just the house was move-in ready, which is exactly what our client wanted to do. He just wanted to, he's working his job, needing to move into place and just, keep doing his job and still have a place that worked for him. So this was just a great fit. So some contract details. Why were we able to get this under contract, Preston, when there were other people looking at it too?
I think a big part was, the other people that had put offers in were definitely under asking price. They thought that there was some room there in the price just because it had already been under contract and they knew that the seller was wanting to get out. But, at the end of the day, we ran the numbers and we knew that this place was going to be a good rental regardless. And looking at the comps in the area and everything else, we felt comfortable with the list price that they had. And knowing we were under a tight deadline, we didn't want to get into a bidding war or bidding situation with the other offers. So everything worked out. Our client had good expectations, and we were able to put the deal together at list price.
And when we did the inspection on that, there were no major items on there, right?
No, we knew about the roof stuff. Everything else was in pretty good shape. We didn't really have any other inspection issues that came up.
And so for the financing, like I said, our client went with a 0% down VA loan. The appraisal came back at above value, which is always great to see. We had 0 seller concessions. And regarding PMI, there's no options to prepay or anything because it's a VA loan. So he did buy the interest rate down as well. So now we're looking at a couple of screenshots here where we just plug the numbers into Joe's spreadsheet. So we'll give you the highlight numbers here in the podcast. Always click on the show note links if you want to go view them yourself, because that will have these screenshots on the blog post as well. And so now we're analyzing the property for not while he's living there, but for once he moves out. Because for these properties, especially since he's nomading it, which is buying a future rental property, we go in there and he's going to live in there, and we don't really, analyzing while he's living there is not the huge concern because he's going to have to pay rent or mortgage somewhere. It's be about the same. But when he moves out in a year or two, we're concerned about the future numbers on here. So we put 0% in the down payment percentage, selected monthly paid for mortgage insurance. Purchase price is $349. His acquisition cost, for appraisal, interest rate buy down, all the other, miscellaneous fees at closing are about $6,500. Loan costs are about $1,500, and that's like the funding fee and processing fee through Castle & Cook. And so his total initial investment is $8,040.
On a $349,000 house. Those are some pretty good numbers there, Chris.
And this is the great thing. I know we sound like a broken record on this, but when we talk about house hacking and nomading, this is why it's so amazing to do, especially with a VA loan. It's just the leverage you get. No investor loan or no investor is getting a loan anywhere close to this. And maybe the best case scenario, you can go out there and find a property, burr it. Even if you walk away and you have $8,000 left in the property after all that, that's a home run in the current market. It's just very hard to do a lot of those like the burr properties right now in Denver. But since this is just a VA loan, owner-occupied property, he can get some amazing leverage, which is the best thing you can do in this type of for this type of property.
Absolutely, I would consider this kind of a home run, as we would like to talk, and especially when you look at that interest rate, right? 3% is what he got his loan at.
Yeah, like I said, this is right as rates started dropping, and he bought his interest rate down. Some was probably at 3.25. He bought it down to 3%. So he's a 30-year fixed at 3%. And this is the other great thing. Inflation is like about 3%, give or take a couple tenths of a point, but he's borrowing money, and it's basically at the rate of inflation, which makes it almost like free money.
It's almost like free money,
because
right?
It's inflating in there. So this is now analyzing a property for after they move out, and we like to be conservative on our numbers when we look at rental income and also the way we underwrite it. So we'll give you what a realistic conservative underwriting number is and how that pans out, and then what the client may do to actually make the numbers better or more optimistic. But we like to be realistic and conservative. So we're estimating rent to be about $1,900 a month. Vacancy, we put it at 5%. Annual rent increase 3%. Annual appreciation rate at 3%. So that rent is probably on the conservative lower side, which is great, especially now with COVID. Right now it does not look like rents are going stagnant or remaining flat. But in a year or two, who knows what the market does?
Yep.
I doubt they'll drop any, but always good to underwrite conservatively. Vacancy 5%. And historically, the last handful of years, Denver's been well below 5%, but 5% is a very good long-term average and underwriting rule of thumb. So we always like to underwrite more realistic and to the long-term average. Now, we selected yes to property management, and like I said, our preferred property manager charges 7% to our clients, but we put in 10% in case they use someone else, and also just to help handle any of those other miscellaneous costs that property managers have out there. Since this is a detached home, we're putting in 8% of the rents for repairs and reserves and capital expenditures. Now, this property was in really good shape, so hey, the first few years, it might be less than 8%.
Yeah, this place was in great shape. I mean, the only stuff that he really needed to worry about after he moved in was, maybe changing out some carpet and painting and resurfacing the deck out back. But other than that, this place is going to be solid.
But again, long-term averages over like a 10, 15-year time frame, you're going to be around an 8%, repairs rate based on this type of property, this location. So again, the long-term average, 8%. Or about 1 month's worth of rent is a really good underwriting rule of thumb. So we selected no to HOA since this is not in an HOA community. Taxes are just under $1,500 a year. His annual property insurance is just over $1,000 a year. And as far as like utilities, water, sewer, trash, electric, that'll all be tenant paid once he moves out. And for landscaping, so mowing the lawn and removing the snow, since it's a single-family home, that's usually
falls on the tenant.
Falls on the tenant.
Yep.
So all those other utilities and other expenses, again, that's going to be tenant responsibility. So looking at the next tab on the spreadsheet, his monthly mortgage payment is about $1,500 a month, and his annual cash flow is going to be a negative $4,000 when he moves out. So let's talk about this here for a minute, because people hear a negative $4,000 and like, oh my gosh, that's a horrible rental property.
That sounds like a terrible rental property,
Why
right?
is it not a terrible rental property, Preston?
Well, think about the leverage that he's got, right? I mean, he only put $8,000 down to get into this property, and he's going to have already some, added benefits for the first few years while he lives there. But look at all the other returns, based off everything else in the return quadrant.
Yeah, and so I think most of the listeners out there have seen that return on investment quadrant. So since this is such a low down payment loan with the VA, it's showing an estimated 203% return. So it's showing appreciation at 130%, cash flow at negative 51%. Again, if his negative cash flow is $4,000 a year, divide that by $8,000 for his initial investment, that gives you that 50%. His debt pay down, 90% return on his money. The depreciation tax benefits, right around 33%. So just these numbers are all just huge because leverage.
It's all about leverage,
Yeah.
Chris.
So if you guys think about, again, go back to your third grade math. You got your fraction. The down payment you put down, or that all-in cost, cash to close, down payment, all that stuff, that's your denominator, so the number on the bottom. The numerator is your appreciation, cash flow, debt pay down, depreciation. Well, since there's such a small denominator, you just get these, you get these high percentage numbers here. Now, we have it estimated around, a negative $4,000 a year in cash flow once he moves out. So Preston already mentioned that, hey, great, think about the leverage because, he only put $8,000 down. So one train of thought was like, yeah, every property cash flows if you put enough money down. But with this case is like, hey, great, he could put $8,000 down. Now, he could have put, $30,000 or $40,000 down to a 5 or 10% down payment to make it cash flow or get right around cash flowing. But then he'd have $20,000 or $30,000 less in the bank. So a lot of our clients are comfortable with that leverage. They say, great, I'm good with a tight to a negative cash flow slightly because I can keep an extra 30 or 40 grand in the bank and basically have my tenants subsidize my down payment.
And I get to keep cash in the bank, right? I mean, it might cost me a little bit of money each month to keep the property at some point, but that's still better use of my money and keeping a big stack of cash in the bank.
Yeah. And then the other thing is, again, we have these numbers written pretty conservatively. So it's pretty common for a lot of our house hackers, nomads, once they move out to help with cash flow, they will self-manage. So if he did not hire a property manager, and he self-managed, that would bring his negative cash flow down to right below like $2,000 a year. So now we're then, that just chopped it in half. Again, we were conservative on rents. Maybe it bumps up a little bit higher. Or if he really wanted to go out there and make more cash flow, he would do room by room rentals.
Yep.
And that would bring in, probably about $800 per room on average, and that would bring his rent up another $400 or $500 a month. Of course, he'll have some utility expenses on there as well, but if he did that, he would be at a positive cash flow number. So overall, I mean, this is a solid property, and just really want to go back and highlight that this was a ultra low down payment using a VA loan. I think since we started these deal analysis, this is the first VA loan we've discussed.
This is the first VA
Yeah.
that we've talked about, Chris.
So if you guys have it out there, if you have the option to use a VA loan, absolutely consider it because you get some amazing leverage. And then understand that, if you use it, you're going to have tighter cash flow because you have really no money in the property, no equity when you first buy the property. So understand that risk to reward ratio, but also understand, hey, when you underwrite the properties, there's other ways you can bring in extra cash flow and also mitigate that risk. So overall, I think this was just an amazing deal.
Yeah, this was a great deal, and I'm really happy that it came together for our client.
Oh, that's the other thing with the timeline. Like that was causing, all of us stress because we always we're one of our things. We're all about speed and getting things done, and that's how we set up our processes and our team. That I work with Joe and just all of our partners is we're about we're efficient, we're effective, and we're about speed. And this is one of those things where hey, we normally have everything in our control as much as we can, but
this one we were kind of waiting on other things to fall into place, and we couldn't really do much about it. But thankfully, it all came together.
Yeah, I think that was karma paying us back for other deals we've done speedy. They're like, hey, it's out of control. Karma said, here you go, guys, get this one done. So it was great, especially since this was right going the pandemic and just the world shut down for a while there. So it worked out really well for our client. So just a great future rental property. All right, so if you guys have questions on here or want to see other types of deal analyses, reach out to us. Our goal is to publish, one a week and just keep you guys up to date as to what we're seeing out there, what type of properties we're closing on. So if you got requests or want to see different aspects in here for what we're analyzing, let us know. We're open for feedback. We want to make this better for everyone out there listening to it. And of course, if you need help putting together your investment strategy, going out there buying a rental or a Nomad in this case, definitely reach out to us. Preston, thanks a lot, man.
Thanks, Chris.